There was once a time on Wall Street where traders made their own decisions on whether to buy or sell securities based on their gut feeling or intuition. They didn't have machines that made millisecond decisions on whether to buy and sell, but everything shifted in 1998 when David E. Shaw founded D.E. Shaw & Co., now widely known as one of the best hedge funds ever created. David E. Shaw didn't have a background in finance. He graduated from Stanford with a PhD in computer science, focusing on computational biochemistry. He researched molecular dynamics simulations to understand the structural changes in protein. He ended up working at Columbia University as a computer science professor, and during his time there, he started to become interested in financial markets. He noticed that these markets are huge data systems, and that price movements could be modeled statistically. At the time, this way of thinking was completely new for Wall Street. Many of the best investors were still using human intuition, charts, and macro opinions to make their trades.
The key feature here is speed, trying to follow what's going on in the international markets so that we can anticipate and catch trends as they occur.
His interest in the market shifted into his first job on Wall Street at Morgan Stanley. There, he joined the Morgan Stanley team as a researcher working on quantitative models, fixed income pricing, and early electronic trading concepts. It was there that he realized there was a huge hole in traditional security analysis. It was in 1998 when he founded D.E. Shaw & Co. It was different from traditional hedge funds at the time. David was still very interested in researching biochemistry, but he also saw something else. Markets themselves were behaving like complex systems. So he decided to run a hedge fund that was able to fund his research. David also took a different approach from hedge funds at the time. He compiled a team of scientists, mathematicians, and engineers. The whole idea was to model markets like complex systems, almost like a laboratory where data replaced intuition. And yes, that is indeed Jeff Bezos. Jeff Bezos worked on the early team at D.E. Shaw & Co. doing computer science, and he later split from the firm to go open up Amazon. His PhD background was the foundation of his trading strategy. In order to understand his trading strategy, we can take the example of a mass attached to a spring. If I pull that mass away from the center in either direction, forces still pull it back to the center. The spring has volatility at times, but always reverts to the equilibrium. This allows us to see the clear, predictable forces that correct the mass back to the equilibrium. And this is where you get the term mean reversion, commonly used in quantitative trading strategies today. Now we can replace the spring system with two related stocks. Stock A can be Coca-Cola and stock B can be Pepsi. Historically, these stocks tend to move together. Both are part of the beverage industry and offer very similar products. Now we can imagine that Coca-Cola reports weak earnings and its stock drops sharply. Investors are selling, but Pepsi's stock price doesn't move. And that creates a temporary imbalance. And historically, when Coke is weak, Pepsi usually reflects the same underlying industry conditions. So something looks off in the relationship between the two. And then traders see this as a deviation from the normal relationship, not just a random move in one stock, but a break in the spread between them. The spread is the difference or relationship between two related stocks. In this case, it's Coke's price minus beta times Pepsi's price. So the arbitrage traders will buy Coca-Cola and short Pepsi. They're basically betting that the relationship between them will return to normal, or in this case, for the spring, the equilibrium. And as the trading flows in, the prices start to adjust and the gap narrows, and eventually the spread moves back to its historic average, or the mean. This was very similar to D.E. Shaw & Co.'s early approach. The most important discovery was that Shaw understood that these arbitrage opportunities were never permanent. The market price tends to move in a random direction in the short term, but relationships between assets can still exist underneath that noise. He understood that you can detect statistically stable relationships with noisy data, or in this case, random price movements. The only way to test if there's a stable relationship is to backtest millions of trading strategies. In doing this, D.E. Shaw & Co. was able to discover stock price patterns in massive data sets. There's been a huge uptrend in day trading. A lot of the younger generation see people online flexing cars, money, penthouses from their day trading profits. And all of these traders use technical analysis. Many try to find price movements or draw lines on a chart, and in times finding these patterns in the stock chart could work. But what really lacks is that they don't know how to backtest their data. And if they do, they don't backtest it enough. Being able to understand these statistical methods to backtest strategies is super important in creating a very strong investment strategy. Shaw's fundamental belief was that markets can be predictable in small ways, and computation at very large scales can expose those inefficiencies. He didn't try to find large moves, he focused on finding tiny inefficiencies and trading on them thousands of times across many markets, much like what quant firms do now. If Coke's price moved a few cents away from Pepsi's, there is a possibility for a gain. And if you do that across thousands of relationships, it becomes meaningful at scale. In 1994, the firm Long-Term Capital Management was created by a former Salomon Brothers trader, John Meriwether. It included several famous economists, including Nobel Prize winners Myron Scholes and Robert C. Merton. Myron Scholes created the Black-Scholes pricing model. This model revolutionized the finance world, and it created a standard for determining the fair value of stock options and derivatives. The team was very skilled in the derivative market. The firm was famous for finding these inefficiencies in the derivative markets, and that's how they were able to put out such high returns for the first couple of years. But in 1998, the firm absolutely collapsed, and it required a huge bailout by the Federal Reserve.
Bright people at the top of that. The average IQ would probably be as higher than any organization you could find among their top 16 people. They individually had decades of experience and collectively had centuries of experience in operating in these sort of securities, and in effect on that day in September they were broke.
David E. Shaw saw this approach and started using it in his own firm. He knew that he had stronger mathematicians, better models, and he gained a large percent from this. Over the last 10 years, the firm has had an annualized return of 14 to 15%, which is roughly 5% higher than the broader market. The crazy part about this whole thing is that they are extremely consistent. D.E. Shaw didn't become legendary by having the highest return in any single year. It became legendary by quietly compounding double-digit returns for decades while avoiding the big drawdowns that destroy most hedge funds. If you enjoyed this video, definitely make sure to go subscribe, drop any questions down in the comment section below, and I will see you in next week's episode.